Hello, everyone. Welcome to our last, just short podcast regarding retirement. Specifically, we're talking about annuities here in part three. We talked about what an annuity is, series of payments, usually a contract involved. Okay. See, the idea is that you put money into an annuity account. And again, it's similar to a retirement in that the part of the annuity that goes in and the contribution to the annuity is not going to be deductible now, and therefore when you pull the money out of the annuity, then it will be partially taxable and partially non-taxable. Typically, people use annuities to supplement retirement savings. That allows them to save more than the restricted. It also works very similar to the idea of splitting out IRA withdrawals between those parts that were non-deductible when you put it in, and when versus those that were deductible. So it fits pretty well in this chapter in terms of how it works. Often an individual will put a lump sum that they've saved or something, or that they have received from a relative or something like that, which would be already taxed if it was taxable. If it was a gift or an inheritance, then it's not taxable when they received it. But that's the investment in the annuity. They go to a financial company and they say, I have $200,000. That becomes the cost of the annuity. In return, the financial institution promises to give them money for either a set period of time, 10 years, 15 years, 20 years, no matter what, okay? Or they say, we'll give you income every month for the rest of your life, okay? And it doesn't matter if you live to be 80 or 120, we will continue to pay it. And so you're putting some of that responsibility on that financial institution to make sure that it has the income, the money it needs to. So it's going to take your money, invest it, and then take the interest and what you originally put in and give it back to you, taking some portion of it for themselves, of course. And so you're asking for them to kind of take over that responsibility, make sure that there's enough in that account. And if the stock market collapses or goes poorly, they're going to have to bear the loss. You wouldn't do so. So that's kind of the context behind an annuity investment. So what we're looking at is the part that they put in during what is referred to as accumulation. It could be one lump sum. It could be you can make multiple payments in it. Okay, that's how much you pay for the contract. Okay, and that's the part that's going to come out tax-free. Any more that comes out is going to be income and interest that was earned by the company while they had your money. Okay, so what you do is you've got the contract amount, the amount you put in, and you have the expected return. So if it's for a specified amount of time, you just say, okay, you're going to get a payment of $100 a month for 10 years. That's 120 payments. So your expected return is 100 times 120. Okay, you got that calculated. If it is over the lifetime, then you have to use those tables, okay, life expectancy tables provided in your textbook, provided by the IRS that the textbook publishes, to see how much you anticipate you're going to get, okay? So you use that to calculate. So if you're going to get $100 for the rest of the month for the rest of your life, you look it up, see how long the IRS thinks you're going to live at the point that you start receiving those payments, and that that the expected return is going to be how much you receive times whatever number of months or years it says you're going to be. Now, that is going to stay the same. With an annuity, it stays the same. All right? Meaning, if you start your annuity at age 70, you look up the table one time, and that's the number you're going to use to calculate the expected return at that point in time. So you're going to take the cost, what you put in, divided by the expected return, and that ratio or that percentage is the amount that you don't have to pay tax on. So the remaining amount is the part that is taxable for every payment you receive from your annuity. Okay? So that's how it's done. And once you have that percentage, okay, then you are good. That same percentage every year for the rest of that time period. Once you reach the end of that expected life, if you're still around, still getting annual payments, then that income, that amount is fully taxable, okay, on an ongoing basis. So once you have reached was your expected life on this annuity, any subsequent receipts are fully taxable. So that's how annuities work, and you see it's kind of it kind of works the same way as withdrawals from retirement plans. So that's why we're talking about it here.